Welcome, ladies and gentlemen. Welcome to Cash Crafting Crew, your favorite finance YouTube channel. Today, diamonds and gold. But before starting the video, remember that this is not a purchase or investment recommendation or financial advice. Everyone should do their own study and analysis and not invest money that you cannot afford to lose. Having said that, we start with the video. Have you ever wondered why diamonds are so much more expensive than gold? It's a question that has puzzled many, and today we're going to unravel the mystery behind it. Now, when we think about diamonds and gold, our minds often associate them with wealth, luxury, and status. It's common perception that these two are some of the most valuable substances on Earth, but have you ever stopped to consider the intrinsic value of these precious items and how it may differ between the two? Intrinsic value refers to the inherent worth of an item, independent of its market value. It's what the item is worth based on its own merits, not what someone is willing to pay for it. For instance, gold has been used for centuries as a form of currency, and is also used in various industries due to its unique properties, such as its conductivity and resistance to tarnish. On the other hand, diamonds, although beautiful and durable, have limited industrial uses, and their value is largely driven by their aesthetic appeal. So why then are diamonds priced so much higher than gold? Is it purely down to their sparkling allure, or is there more to it? Interestingly, the answer lies not just in the present, but also in the past. It's a story that involves history, economics, and the complex dynamics of supply and demand. And it's a story that we're going to unfold in this video. We'll take a journey back in time to understand how the pricing of diamonds and gold has evolved over the centuries. We'll also explore the various factors that affect their pricing in the present day. And of course, we'll shed light on the intriguing price paradox that exists between these two precious items. Intrigued? You should be. Because understanding the reasons behind this price paradox is not just fascinating, it also offers insights into the intriguing world of precious commodities. So let's dive deep into the history to understand the reasons behind this price paradox. Gold, known as the metal of the pharaohs, has been treasured for its intrinsic value since antiquity. It has been used as a medium of exchange, a store of value, and a symbol of wealth and power. But how exactly has the price of this precious metal been determined throughout history? In ancient civilizations, gold was often bartered for goods and services. The price was subjective, dependent on the perceived value between the two parties involved. However, as societies evolved, gold began to serve as a standard for currency systems. Enter the gold standard, a monetary system where a country's currency is directly linked to gold. This system came into prominence in the late 19th century and fundamentally influenced the global economy. Under this system, the value of currency was directly tied to gold, providing a measure of stability. But it wasn't without its flaws. The reliance on gold limited the flexibility of the economy, especially in times of crisis and war. In the 20th century, most countries abandoned the gold standard, moving toward fiat currencies. This shift separated the value of money from the physical quantity of gold, allowing for more economic flexibility. However, gold retained its allure and importance. The price of gold in this modern era is influenced by a myriad of factors. Inflation, for instance, often drives investors to gold as a hedge, pushing up its price. Geopolitical instability can increase the demand for gold as a safe haven, again, bolstering its value. And of course, the basic economic principle of supply and demand plays a significant role. When gold supply diminishes or demand increases, the price of gold escalates. So from its ancient roots as a bartered good to its modern role as a valued investment, the price of gold has been shaped by countless factors. It's a precious metal that has weathered economic upheavals, witnessed the rise and fall of empires, and continues to hold its ground in the global economy. Gold has always held a unique position in the global economy. But what about diamonds? Diamonds, on the other hand, have a much more recent history of commercial value. Unlike gold, which has been treasured for millennia, diamonds didn't become commercially valuable until the late 19th century. The story of diamond pricing begins in South Africa in the late 1800s with the discovery of massive diamond mines. This discovery could have flooded the market, driving prices down. However, the major mine owners, led by Cecil Rhodes, formed a syndicate to control production and keep prices high. This syndicate eventually became De Beers Consolidated Mines, a name synonymous with diamonds even today. De Beers maintained its monopoly over the diamond industry for over a century by controlling a significant portion of the world's rough diamond production and distribution. They created an artificial scarcity, releasing only a limited number of diamonds into the market each year. But the control of supply was only one part of the equation. The real genius of De Beers was in creating demand. In the 1930s, they launched one of the most successful advertising campaigns in history with the slogan, "A diamond is forever." This campaign ingrained the idea that a diamond engagement ring was a necessary symbol of love and commitment. This marketing strategy, combined with their control of supply, allowed De Beers to dictate the price of diamonds for decades. However, the diamond market has changed significantly in recent years. De Beers no longer holds the monopoly it once did, and the discovery of new diamond sources has disrupted the market. Despite these changes, the perception of diamonds as a symbol of wealth and love created by De Beers remains. So, while the history of diamond pricing is relatively short compared to gold, it's a fascinating story of market control and brilliant marketing. It shows how perceived value can be just as important, if not more, than intrinsic value in determining price. So diamonds and gold have different historical and economic backgrounds, but how does this translate into their current prices? The price of gold in today's market is influenced by a variety of factors. Let's delve into some of these factors that play a significant role in shaping the price of this precious metal. First up, we have central bank reserves. You see, central banks hold gold as a reserve asset. When these banks buy more gold, the demand increases, causing the price to rise. On the other hand, if they sell off their gold, it increases the supply, which can lead to a drop in price. Next, we have interest rates. Gold does not pay interest or dividends, so when interest rates are high, investors are more likely to choose interest-bearing assets over gold. Conversely, when rates are low, gold becomes more attractive, pushing up its price. Now let's touch on global crises. Gold has traditionally been seen as a safe haven in times of political or economic uncertainty. So when there's a crisis, whether it be a war, pandemic, or financial meltdown, investors often flock to gold. This increased demand can drive up the price substantially. Another factor to consider is inflation. Gold is often used as a hedge against inflation. When the cost of living rises, the value of currency falls, but gold retains its value, making it an attractive option for those looking to protect their wealth. So, as inflation rises, so too can the price of gold. Lastly, it's important to remember that gold is a liquid asset. This means it can easily be bought or sold without significantly affecting its price. This liquidity makes gold an appealing choice for many investors and can contribute to its price fluctuations. These factors, from central bank reserves to global crises, from interest rates to inflation, all intertwine and interact in complex ways. They create a dynamic and ever-evolving landscape that influences the price of gold. These factors combine to create a dynamic and ever-changing price for gold. Now let's turn our attention to diamonds. Unlike gold, the price of diamonds is not as straightforward. When it comes to diamonds, several factors come into play, making their pricing structure far more complex and often higher than that of gold. Let's start with the 4 C's: cut, clarity, color, and carat. The cut refers to how well the diamond has been cut from its raw form. A well-cut diamond reflects light beautifully and is more valuable. Clarity measures the diamond's purity. The fewer the inclusions or blemishes, the higher the price. The color of the diamond also factors into its price. The less color a diamond has, the higher its value. Finally, the carat or weight of the diamond plays a significant role. The larger the diamond, the more expensive it is. Market control is another major factor. Unlike gold, the diamond market is tightly controlled by a few major companies. These companies regulate the supply of diamonds, effectively maintaining high prices. De Beers, for instance, has been a dominant player in the diamond industry for over a century, and their influence on diamond prices cannot be underestimated. The rise of synthetic diamonds is another aspect to consider. These man-made diamonds, identical to natural diamonds in almost every way, are becoming increasingly popular. However, their production cost is significantly lower, leading to a more affordable price point. This development has added a new layer of complexity to the diamond pricing equation. Lastly, it's important to note that diamonds are not a liquid asset. Unlike gold, which can be easily sold in many forms, selling a diamond can be a more complicated process, often resulting in a lower resale value. This lack of liquidity can also contribute to the high price of diamonds. These factors create a complex pricing structure for diamonds, often leading to higher prices compared to gold. So the next time you marvel at a dazzling diamond, you'll understand the myriad of factors that contribute to its price tag. So, why are diamonds so much more expensive than gold? Well, let's weave together the threads we've been exploring. To understand the price paradox of diamonds and gold, we have to consider three critical elements: perceived value, market control, and historical factors. Firstly, perceived value. Diamonds are often associated with luxury, glamour, and love. This perception, fueled by effective marketing campaigns, has elevated the perceived value of diamonds. Remember the slogan, "A diamond is forever." That ingenious phrase, coined in the mid-20th century, linked diamonds with the enduring nature of love and commitment, thereby increasing consumer demand. Gold, on the other hand, has a more practical association. It's not just about adornment. Gold is also used in electronics, dentistry, and even aerospace. But these practical applications don't necessarily inspire the same emotional response or perceived value as a diamond's sparkle. Secondly, market control. The diamond industry has been historically controlled by a few major companies, allowing them to regulate supply and demand. By limiting the supply of diamonds, these companies can maintain high prices. Gold, conversely, is a more decentralized market with numerous mines and sellers worldwide, making it harder to control the price on a global scale. Lastly, historical factors. Gold has been a symbol of wealth and power for millennia, and its value has remained relatively stable. Diamonds, though, haven't always been as coveted. It wasn't until the late 19th century, when significant diamond deposits were discovered in South Africa, that diamonds became a sought-after gemstone. This relative newcomer status, combined with aggressive marketing and tight market control, has allowed diamond prices to skyrocket. So the price paradox between diamonds and gold can be boiled down to a complex interplay of perception, control, and history. Diamonds cost more because we believe they should, because the supply is carefully managed, and because their status as a symbol of luxury is a relatively recent development. And there you have it, the reasons behind the price paradox of diamonds and gold. Let's recap what we've learned today. We've journeyed through the annals of history, tracing the pricing trajectories of two of the world's most coveted materials, gold and diamonds. From the age-old reverence for gold's imperishable luster to the 20th century invention of diamonds' perceived rarity, we've seen how human narratives have shaped their values. In the present day, the price tags on these precious substances continue to be influenced by a mix of factors. Gold's pricing is subject to its tangible applications in technology and adornment, along with the whims of global economies. On the other hand, the diamond market is largely steered by the controlled release of supply and the sustained myth of its scarcity. The price paradox, then, is a fascinating outcome of these intertwined histories and market forces. Next time you see a diamond sparkle or a gold glint, you'll know the fascinating history and economics behind their prices. We hope you liked the video. If so, it would help us a lot if you left us a comment, since the YouTube neural network values this very much and thus recommends our videos to more people. Give it a like and activate the bell so that you receive a notification when we upload our next video. So, see you soon. Greetings.